Hello learners, in this video we are going to talk about the derivative segments through a trader's perspective and its applications and use in the Indian stock market. Let us start. So coming with the contents, first of all we are going to talk about what are derivatives, how to unlock them and everything else. The power of futures, which is the first type of derivative that we use in the Indian stock market. Then we'll talk about the options. Swaps is one more thing that we have in the stock market, but we don't generally use that. But still, we're going to go through its contents. We'll talk about how to decode the marketing analysis, trading strategies, the risk managements, and our next step towards the application of derivatives. So let's start with the understanding of what are derivatives. So first of all, the overview of the derivatives. Let us check in the website. Let us check in the web what are derivatives. So as we see in the web, we can see it's written web are financial contracts whose value is linked with the value of an underlying asset. They can be used for various purposes, including speculation, hedging, and accessing additional assets or markets. So this is the most important word that is used over here, that is hedging. So what is hedging? Hedging is a process by which big investors, big players in the market who have invested huge amounts of money, what they do is they hedge their quantities so as to reduce the amount of risk taken in the market. Let us see it by an example over here. So here I've just opened a brokerage account in Motilal Oswal. You can just watch it over here. Let us go to the orders section. As we can see, there are no orders over here. So let us get to an example. So in this is the type of FNO contracts that we will talk about today. This is the chart, the Bank Nifty. Let us go through this chart. This is the chart of the FNO contract that we are going to talk about today. So what is futures and options? We'll go through that as well. First, let me show you how to put up the charts of futures and options in a brokerage account. Let's see. So in the search bar, we are going to get in the search bar. And if you want to search about the derivatives in NSE, we are going for Nifty futures, which is the first type of derivative that we see. So here you can see Nifty 27th March, 24th April, May. These dates that are being shown over here are the expiries of these future contracts. If you want to go through the chart of this, we can just click over the chart option over here, and here the chart will be opened. This is the Nifty futures contract, which is one type of derivative. So this Nifty futures contract is very similar to the Nifty 50. If you just go into the market, this is very similar to the Nifty 50 actual index, but this futures contract that we are seeing over here has an expiry which is 27th March. On 27th March, this futures contract is going to expire and its value is going to be 0. Until then, if we want to directly invest with the strike price of Nifty, we cannot do it actually in the index Nifty. So instead of that, we have a futures contract available over here through which we can put our buy and sell orders over here. As you can see, there are buy and sell orders over here in this market. We can simply click on buy, and here we will get the lot size. There's a certain lot size that is being provided over here, below which we cannot put any orders. So there's a certain lot size that needs to be invested into the market. Below this lot size, we cannot invest in the futures contract. So since we can see I have a lot size of 75 in the Nifty futures contract. This is a new account, so I don't have any cash present over here, but I can just give you an overview of how it's being done. Let us see. So if we carry forward with one lot, the lot size is 75, the required margin is 1,91,565. The one good factor that is being provided in the futures contract is we get a good leverage over here, almost 4.5 to 5x of leverage in Nifty future contracts. So if you just calculate it, if you just open the calculator and look at the actual price of Nifty, let us see what is the actual price of the futures contract. It is 22,512. Let us see. And the lot size is 75. So if we just calculate it, 22,000, what the value was, 510. Let it take us 510 only. And we multiply it with 75. So its value is going to come over like 16 lakhs over here, right? But we don't have to pay 16 lakhs as we have seen over here. What the required margin is, it's almost nearly approximately equal to 2 lakh rupees only. So as we can see, it is more than 8x leverage that has been provided over here in the markets when we trade with the futures contract. So this is one very good thing that we can use to our benefit and trade with more lot sizes since the leverage is applied already in the futures contract. Similarly, that happens with Bank Nifty as well. If you just want to see, let me just do it for once. Mm, let us go with Nifty Bank futures. Nifty Bank futures. So here Bank Nifty futures are being opened. Similarly, we can do buy and sell in the Bank Nifty futures as well. If you want to trade in the Bank Nifty prices directly, this is the Bank Nifty futures chart present over here. As you can see, Bank Nifty index futures, and this is the main stock chart of the Nifty Bank index. We have shown you in the trading view as well. Similarly, in the trading platform as well, here is the Nifty futures contract of the this present current month. Let us go into the chart section. So here you can see this buy and sell orders are available over here. So let's not take on the sell order. So this is going to give us profits when the market value is going to go down in the downward direction. And this has a lot size of 30. So if we click over here, we'll see that it requires 2 lakhs again. If we calculate over here 47,997, let us take it as 48,000 only. If we just calculate, so this will go up to like 14 lakhs and something. But this also requires only approximately close to 2 lakhs, which is also equal to almost 8x leverage. So as we have seen, this future contracts already comes down with a good leverage position available in the market, which we can use to our advantage and trade on more lots with lesser amount of money. So this is how what the future contracts are. Now let us go. Okay, now let us go and talk about the next section. The core concepts we have talked about. What are the future derivatives? We have talked about trading insights. As you can see, we have trading insights. Let us go through this market over here. As we have already talked in the chart pattern sections, we can go through the chart patterns over here, make a good sell and buy trades over here like this. This is a good long bearish candle being provided over here. So if we want, since it has crossed this position, uh, let us put a trade over here like this, just like this. Okay, so taking this as a stop loss, we can just put a trade over here with approximately risk to reward of 2x. So as we can see, we have achieved it. So I'm sorry, I've put a long position over here. Let's go with a short position. Now we can do like this. Okay, so taking this big red candle as a stop loss, it's high as a stop loss, and 2x is our target. We can just go with this and see that it has provided around like 5:1 risk to reward ratio, and the risk to reward ratio is turned to 5.48 here in the market, resulting in the movement of around 700 points in the downward direction. Similarly, if we had done that, we would gained it like 700 points into the lot size of 30 points. If we had just invested one lot, if you want to calculate for these 700 points, we would have got like approximately, we calculate like over here, we would have made a good profit of around 21,000 in this trade only if we would have invested with one lot over here in the Bank Nifty futures section. So this is what the future contracts is all about. Okay, now let's move forward. Strategies, we have already talked about that. Generally we use these contracts as hedging contracts. When we have huge buys in the futures, we use options as hedging, and when we have huge buys in cash, we use futures as hedging. Because we can put a futures contract into sell side as well and buy side as well, regardless of the cash section, which we can only go for buying in the market. Like for HDFC, if we are buying HDFC in cash, we can only put our buy orders in the cash segment. But when we are using futures, as I'll show you over here, HDFC2 is a futures contract. HDFC futures, if we write, you can just see that HDFC Bank 2 has a futures contract available. This is the chart of the HDFC futures contract. If we believe we have bought huge quantities of HDFC uh, HDFC stock price in the market, and if we think there is a huge bearish movement coming into the market, and we do not want to sell our positions, even in the daily section as well, if you want to see, let us reset the chart, widen it. If we see there's a huge long downside momentum over here until the support level is reached and it has taken support to move forward in the market, if we think that we do not want to have a headache of this market fall, we can just put a futures contract into the sell position over here with a lot size of 550. If you put one contract, it is around like 1.64 lakh rupees. So until and unless the market is moving in the downward direction, we will not be losing money and also gaining profits as a hedge format here after putting a sell contract into the HDFC Bank futures section. Thus, it acts as a hedge when we have huge quantities bought in the cash segments and we do not have to panic and sell our positions in the market. This is how we use futures contract for hedging. Similarly, if we have bought huge futures contract in the market and we think that this market might fall over here in the future, we can just go over the option segment over here, just like a 17,050. If I put, let us see, this is 17,040. This is a call option, here's a put option. So this is the, what you can say is a futures chart over here. If the bank is moving in the downward direction and we have futures contract being bought over here, we can simply use this this options contract as the hedge position for this futures contract that we have bought before in the market, thus creating a hedge position and reducing our risk of losses. That's how we use derivatives as hedges, including speculation, hedging, and accessing. That's how this hedging is decoded in the derivatives market. So that's how futures we have defined. Market trend tools, price stability, hedging tool it has. We have already talked about futures as a hedging tool. Futures we have defined already. Speculations and how to trade in the futures market we have already talked about, right? We can just do with the simple price action techniques that we use in the cash segments. We can do it in the futures segment as well with the futures chart available, right? So moving forward, options we have talked about. Let us go once again. Options are like options are like, buy and sell assets which are available as contracts in the market that we use as hedge positions for our futures or sell orders that were available or active in the market. So just as I defined you here, when we have huge buy segments available in the market and we think that market is going to fall, we can just buy the put options in the same contract available, thus reducing the risk of our losses and putting a hedge option in the market, right? That's how hedging is explained in future options contract. Okay, moving forward now. Swaps can be agreements between two parties to exchange cash flows or other financial instrument, optimizing financial positions. So these are simply the swaps. We can talk about like another derivative segment that we generally don't use in the market, but it has generally been used in the US markets. Indian markets, we don't generally find that. But it has a derivative contract which two parties can exchange the cash flows or liabilities from two different financial instruments. Like I'm been trading in BankNifty. I'm just giving an example. I've been trading in BankNifty, but I want to use my liabilities of it as a uh, leverage to trade in the Nifty section. So that contract I can use as a leverage to trade with that money into a completely different instrument. That is what we call it as a swap segment. That's how swaps are defined. Moving forward, so analysis in depth, we have already talked about how derivatives work in the market and why do we use derivatives generally. We can use it as naked derivatives as well. Naked derivatives means not putting it as a hedge quantity, but just putting it as a instrument to put a buy or sell orders in the market to gain some monies. Generally, we use these derivative segments as hedging tools, but we can put naked orders also in the market just like this. If we just want to buy buying, just want to buy options contract of the HDFC, we can just put a one lot per position over here and we can just put orders here, simply like that. That's how we can use these segments as hedging tools as well and as naked tools as well, just to earn some money from it, just in form of a trading. Just like we do intraday trading, we can do it options trading as well, or the futures trading as well. Here, long-term strategies I've already talked about. You can just use the normal trading strategies that we use. Let us go through this section over here. We can just calculate these trend movements into the market and just watch these movements and put buy and sell orders over here according to the movement of the markets in that point of time, right? That's exactly how we can use it for futures and options contract as well. So now mastering trading strategies. Trading strategies I've talked about. Hedging I've already talked about. Arbitrage. Arbitrage we can define as which is seeking profit from price disturbances across different markets, exploiting inefficiencies for risk-free gains. So arbitrage is simply putting a different position into a different instrument or in a different market, thus reducing the risk of losses in total. The net losses can be reduced by putting different markets into the picture, and trading through different indexes. That's what arbitrage is all about. So risk-free gains. Risk-free gains is just a normal term that we talk about for getting profits in the market by just moving through arbitrage trading that we have already talked about. We can, if one market is moving downwards, one market is moving upwards, we can just talk about. Just for example, if I show you the global markets, now currently talk about the global markets over here. So this is the Dow Jones futures in US market, European market, FTSE, the the German DAX. Sorry for this ad. Just let us refresh this page once again. Okay. So this is the British market, FTSE, CSE, the French market, the German DAX market. And now coming to the Asian markets, that is Japanese Nikkei, Gift Nifty of our Indian stock market, Nifty, Gift Nifty. This is the Singapore one, the Hong Kong, Taiwan, Japan. Sorry, this is South Korea. This is Kospi, South Korea. Now this is Singapore Exchange once again, Jakarta Composite, and this is the Chinese Shanghai Composite. Right. So these are the different types of indices, Asian indices, European indices, and the US indices available in the market. Here we can use the CFD or the that we have already talked about, CFDs, or the if I just put over here CFD, we'll get the understanding contract for difference in the derivative trading. That is a completely US term that we use in the US market, but here in the Indian stock market we don't use arbitrage or swap trading. We generally go with futures and options contract for hedging positions, even for the naked positions as well. So this is what the futures and options contract is all about. Now let's moving forward. Um, so now coming to the normal understanding of the market, we need to keep continue our learning. We need to stay focused in the market, learn new ideas, learn new trading setups into the market. Next comes the practice makes perfect. This is a simple term. We keep practicing the market, we learn new ideas, we make our own trading strategies, and share with you as well. That's how you can also make your own trading strategies and trade accordingly, starting with one lot at a time, and then increasing your lot size as per the confidence and your results and accuracy in the market. Informed about the global indices as well. Yes, definitely the global indices that we have talked about. Sometimes these global indices market movements can also impact our Asian markets as well. The Asian markets nowadays have become really independent, but there was a time when Nifty was completely dependent on the Dow Jones and the Nasdaq futures index. Their market used to define our movements in the indices as well. That was a sort of impact that Nasdaq before had in the Nifty. But nowadays, Nifty is more of an independent indices, but you still need to be aware of the global market indices, what's happening in the market. And through this global markets indices sections, we can find it money control. You can just go through global indices into the web, and money control first link will be opened. You can just go through these and find out what's happening in the world. Just like in the Asian markets, you can see there's a great sort of loss going into the market. Japan is under loss. Taiwan, Hong Kong, Korea, Shanghai, and the Chinese economy is also under losses currently. So we can expect a decline in our Indian markets as well. So that's why we can just see the global trends and understand what's going to happen in our markets as well. So we'll be prepared for them, and we can be one step ahead for our trading strategies as well, and what sort of trades we need to take in the market, and we will be avoided from sharp, fake movements in the market. So now seeking guidance simply learning from the pros, learning through books, defining trading strategies, learning technical analysis, understanding the global trends. That's what seeking guidance is all about. Okay. So thank you. This is the normal introduction of us to the derivatives market. And this is how we are going to start with the derivative sections and keep understanding in the future coming videos as well. Thank you.